Hey, welcome, guys. Oh, geez, pulling my mic too hard. Uh, it is what is today? Wednesday night, July 2nd, in preparation for Thursday, July 3rd, part day before moving into the holiday environment on Friday. No trading on Friday. We all get a weekend off. I'm going to have some ribs, some good food. So I hope you guys have some good plans this weekend as well. I know Dustin and I are relaxed and ready for this evening's video, but let's get at it here. Wanted to start with the Market Wizards interview with top traders by Jack Swagger. We are on James B. Rogers Jr. He goes by Jim Rogers. Jim Rogers began trading stocks with $600 in 1968. By 73, he formed the Quantum Fund with his partner George Soros. The Quantum Fund proved to be one of the best performing hedge funds. And in 1980, after having amassed a small fortune, he retired, quote unquote, retired is the word that he used to describe managing his personal portfolio. Um, let's see, I don't want to read through all of this. Oh, he said, I'm probably not the person you want to interview. I often hold positions for many years. Furthermore, I'm probably one of the world's worst traders. I never get in at the right time. He was referring to the distinction that I had made in my letter, indicating that I was interested in great traders rather than great investors. But all right, so I'm going to jump through a lot of this stuff. Uh, do you always wait for a situation to line up in your favor? Don't you ever say, well, I think this market is probably going to go up, so I'm going to give it a shot, is what Jack Swagger said. Jim Rogers' response was, what you just described is a very fast way to the poorhouse. I just wait until there is money lying in the corner, and all I have to do is go over and pick it up. I do nothing in the meantime. Even people who lose money in the market say, I just lost my money. Now I have to do something to make it back. No, you don't. You should just sit there until you find something. That's a great quote. Just wait until there's money lying in the corner. Wait until it's like I have no choice but to enter this trade type thing. Schweiger says, so you mean trade as little as possible? And Jim Rogers says, that is why I don't think of myself as a trader. I think of myself as someone who waits for something to come along. I wait for a situation that is like the proverbial shooting fish in a barrel. Swagger asks, says, are all your trades fundamentally oriented? Jim Rogers says, yes. Skip through a bunch of stuff here. Were you short the stocks or long the puts? Rogers says, I was short stocks and short calls. I don't buy options. Buying options is another fast way to the poorhouse. Someone did a study for the SEC and discovered that 90% of all options expire as losses. Well, I figured out that if 90% of all long option positions lose money, that meant that 90% of all short option positions make money. If I want to use options to be bearish, then I sell calls. Um, One moment, just flipping through a bunch of pages here in this chapter. I know there was stuff at the very end I wanted to get into. So I'm still here. Hang on. Oh my gosh. How many pages did I skip? Oh, okay. Any at the end of the chapter. Any last words? Asked Swagger. He said, good investing is really just common sense, but it is astonishing how few people have common sense. How many people can look at the exact same scenario, the exact same facts, and not see what is going to happen? 90% of them will focus on the same thing, but the good investors or traders, to use your term, will see something else. The ability to get away from conventional wisdom is not very common. Jim Rogers' approach may be difficult to emulate in its entirety, but many of his trading principles are of great relevance to all traders. His basic concepts are one, buy value. If you buy value, you will not lose much, even if your timing is wrong. Number two, wait for a catalyst. Bottoming markets can go nowhere for a very long period of time. To avoid tying your money up in a dead market, wait until there's a catalyst to change the market direction. Number three, sell hysteria. The principle is sound, but its application is far from easy. Rogers' methodology can be paraphrased as follows: wait for hysteria, examine to see whether the market is wrong, go against the hysteria if fundamentally validated, be sure you are right, and then hold on tight. The tricky part are the last two steps. Um, I kind of skipped through some of that. Number four, be very selective. Wait for the right trade to come along. Never trade for trading's sake. Have the patience to sit on your money until you have a high probability trade set up exactly right. Number five, be flexible. Biases against certain markets or types of trades limit your field of opportunity. A trader who says, I will never go short, has a distinct disadvantage compared to the trader who is willing to go short as well as long. The trader who is open to examining a broad range of markets has a distinct advantage over someone who is willing to participate in only one market. Number six, never follow conventional wisdom. Keep this principle in mind, and you will be less likely to buy stocks after the Dow has already moved from 1,000 to 2,600, and everybody is convinced that there is a shortage of stocks. So never follow conventional wisdom. Let me repeat that. Keep that principle in mind, and you will be less likely to buy stocks after the Dow has already moved from 1,000 to 2,600, and everyone is convinced there is a shortage of stocks, meaning that they're going to start, they just need to buy it up. Number seven, know when to hold and when to liquidate a long position. If you believe the market is going against you because your original analysis was flawed, such as when you realize you've overlooked an important fundamental factor, then, as Rogers states, the first loss is the best loss. However, if the market is going against you, but you are convinced that your original analysis was right, then sit out the hysteria. As a cautionary word, this latter condition should be applied only by traders who fully understand the risk involved. All right, the next chapter is Mark Weinstein, high percentage trader, which we'll get into probably next week. All right, wanted to jump in here on my notes. I wanted to pull over the daily chart here. Okay, wanted to zoom in on this, show the persistency of trend that we've had. We did kind of a V bottom, so to speak, 50% retracement, 50 to 61% retracement here, and then we've been off to the races. That was a fairly significant move down here in a short period of time. We moved from 218 until 48, so 2 months of almost straight down in an ABC like fashion. Then we did a little higher low and started off here. So what we've had after that higher low is we had the first persistency of trend, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days. Then we had the first close below the 5 SMA. That set up the first buy. Typically, you would buy at the close of that day, even hold it through any drawdown, and you don't exit the position until you close back above that 5 SMA. So, that would have been a small profit there on that one. Then you had 1, 2, 3, 4, 5, 6, 7, 8, 9. Again, you buy here on this 5 SMA. Went through a little bit of a drawdown, but it bounced off the 20 period moving average, and we closed above it. Small gains on that 5 SMA, but these do have probabilities, higher probabilities. The third one we went through, we've gone through 9 days. We did that's where we did the 3-bar, the close below. Then the very next day we closed above, so that was a decent gain there on that 5 SMA buy. The close below, the sell out, the close back above that. Kind of did a little 1, 2, 3, 4 days down. Then we started this next run. Now currently we are on this next run of day 8. Tomorrow would make day 9. So again, you're looking at we had a 10-day run, 9-day run, 9-day run. So if that same type thesis holds true here, we are getting pretty long in the tooth on this last run here. And like I said, you've kind of seen these 3 SMA buys. So one here, like first leg, second leg, this one could have been considered the same because it's almost a sideways consolidation here. And then this next move up here. Also down here on the 2-period rate of change, we are continuing to have diverging 2-period rate of change. All of this is screaming that this market is ready for some kind of a correction, some kind of a down day here. It's just a matter of when will that come. Also wanted to show the 65,000 tick chart. Oh, that's here. So 65,000 tick chart, you can see that we had, kind of this sideways. I kind of marked the tops of these areas here and the bottoms of these areas here as a projected box measurement. And then I just kind of put that on top here to see what roughly what are we looking for a projected move up. So around 63.12, 63.13 it is a potential projected upside. Does not mean that we will reach that. Wanted to look at the 240-minute chart here. This is that, oh no, that's 60-minute, 240. So the 240-minute chart here, we kind of went over this a little bit. We're continuing to get this one push, two pushes up in here, third push up in here on the LBR 310. I mentioned the other day that I was waiting to see if we get a second KCR reversal up in here. See if we get another push outside here for then a reversal, or a failure below the 20-period moving average, which let me move this line. I don't know if you guys can see that, but my 20-period moving average is this this kind of gray line right here. So a failure below this 20-period moving average. So either push up and test this upper band, or we start failing this little breakout here and come back down below that 20-period moving average. We can also see this same kind of thing on a 60-minute version. On the 60-minute version, I'm looking for, like I said, either a push back up here around the 62.87, 88 range right now, if we move back up there, or if we fail, come back down into this zone. Let me zoom back out here on this. Come back down in this zone and start coming below this 20-period moving average. That's, so I'm looking for one of those two scenarios, either move up and a failure at the upper Keltner channel, or just a failure from here and a move back down below that 20-period moving average. However, I want to balance all that with the fact that we are on a pre-4th of July week, and wanted to read here real quick. As a reminder to all of us, hang on. I think this was on Monday. Yeah. So on Monday, I mentioned this is the retweet by Linda. Stats du jour, according to Arthur Merrill, the probability of the stock market recording a gain on July 3rd is the highest in the entire year. Seasonal strength combined with tendency for the market to go up the day before a holiday. So we want to keep that in mind. It does not say by how much, so that just means a green day. It doesn't project, oh, we'll have, a 60-point day, 100-point day. It just means we could be in the green. Also wanted to pull over the 60-minute gap chart here. Okay. So on this here, on the 60-minute gap chart, on this move up, we've left this gap down here below. Again, you remember we had a couple other gaps down below here. I won't retrace back into those, but we've got some other gaps left down below. Right now, we had the first Keltner channel reversal option came in here on this Keltner channel reversal. We did not hit that 20-period moving average. The second Keltner channel reversal came in, oh, where did I? Oh, yeah, the third. Second one came in here, opened up, gap down. Now, this did not touch the 20-period moving average. At the time, this was still working its way, moving up. It did not touch the 20-period moving average. Possible third here today, or yesterday, where we opened up below. So that's a close, close technically below that. And we did not make our way back down. Closed down at the end of the day. I thought maybe that would be the day today. However, today we just did that momentum or pinball buy, and it just trended straight up on the 60-minute here. So we've trended straight up. Again, I'm looking for, do we have one more Keltner channel reversal or just that failure of the 20 period moving average on the dot D? Again, I want to keep bringing our attention back down to this pattern on the LBR 310. When we see this staying above here, even though the fast line's dipping below, the slow line is not. That's indicative of, hey, this strength. The more times we point this out to ourselves, the maybe just one of these days we'll get on board and stop trying to short this thing until the market shows us otherwise. Right. And then I wanted to touch on the internals here on the VIX. Again, this is screaming a story for us here. We're continuing to get this diverging on the VIX while this price is continuing to move up here in the SPY. So it's just a matter of time. It's a matter of time before the VIX wins out, this breaks down, given all the things. So we got to be prepared for that, guys. When that day comes, it could be a good trending day. We want to have our minds ready for that. We want to have just be aware of that type day when it does approach. So, all right, that's it for tonight. We will talk again. If not tomorrow, then we will follow up on Sunday evening for next week. Happy trading tomorrow if you are going to trade. Otherwise, enjoy your weekend. Talk soon.